Today we're tackling the 9-month 2025 numbers for Anadolu Isuzu. That's ticker ASUZU. Our goal here is simple. Take all this complex financial data, the reports, the statements, and really break it down for you, the individual investor. We want to understand what's driving this company.
Exactly. We're looking beyond just the headlines. We're digging into operations, the financial risks, where they're headed.
And importantly, trying to see what choices they're making right now. Trade-offs between growth and, well, stability.
And just a key point up front, especially maybe for listeners outside Turkey, these financials use TMS 29, inflation accounting.
Right. Crucial context.
Absolutely crucial. It means all the comparisons we make, like 9M 2025 versus 9M 2024, they're already adjusted for inflation. Without that, honestly, the numbers wouldn't mean much.
Good. So apples to apples comparison.
Yeah.
Essential. Okay, before we get into the performance, maybe let's just lay the groundwork. Who exactly is ASUZU?
Sure. So ASUZU, they're a big player in the Turkish commercial vehicle scene. They make trucks, vans, buses, minibuses, pickups, a pretty wide range. HQ is in Istanbul, Ümraniye specifically, but the actual production happens out in Sayarova, Kocaeli.
And they're not just domestic, right? I saw they export quite a bit.
Oh, yeah, very much so. They export to 46 countries, working through about 39 distributors. So that global angle is really important to their business model.
Okay, and something that jumped out at me from the activity report was their R&D focus. Seems like a big priority.
Huge. They were ranked 25th, I think, in Turkish Time magazine's list of top R&D spenders for 2025. That's significant investment.
And it looks like it's focused on the future, right? Electric, alternative fuels.
Precisely. Electric vehicles, alternative fuels, connected tech. They're putting money into things like the new Grand Toro XL, the Nova City Volt. It's clear they're trying to, stay ahead of the curve.
Makes sense. Okay, what about who owns and runs the company? The shareholder structure looked interesting.
Yeah, it's a mix. You've got the AG Anadolu Grubu holding with the majority stake, over 55%. Then their long-term Japanese partners, Isuzu Motors and Itochu Corporation, holding significant stakes too, around 17% and 13% respectively.
But ultimate control sits locally.
That's right. The Suleiman, Camille Yatashisha, and Erzohan families ultimately hold the reins.
And the board, how diverse is that?
It's a board of 15 members, and it's worth noting there's one woman on the board, Layali Devaliolu, so about 6.7% female representation. She also chairs the Risk Committee, which is a key role.
Okay. And staffing, growing much.
Modestly. Total employees are up slightly to just over 1,500. It's split fairly evenly between white-collar and blue-collar workers, around 616 white, 891 blue.
And executive pay, any major changes there?
Actually, a slight dip in real terms once you factor in inflation. Total compensation for top management went from about 140.6 million TL last year to 134.3 million this period. So down a little.
Interesting. Okay, now let's set the scene for the market. How did ASUZU perform relative to the overall industry?
Right. This is important context for understanding their results. The overall Turkish vehicle market saw production rise about 3% in the first 9 months of 2025, and commercial vehicle exports specifically were actually up quite strongly, about 28%. So a generally positive environment.
Well, ASUU didn't quite follow that trend, did they? Their sales volume actually fell.
Exactly. That's the surprising bit. Their total unit sales dropped by 13% compared to the same period last year, down to 4,457 units.
So the market's growing, but they're selling fewer vehicles. Why?
Well, it seems like a deliberate move. If you dig into the production numbers, you see a massive drop in one specific category. The camionettes, so vans and pickups, production there went from almost 1,200 units down to just 248, a huge cut.
Wow. So they consciously decided to make fewer vans. Why would they do that?
It strongly suggests they're managing inventory, maybe responding to demand signals, but more likely focusing their resources. Pruning lower margin products, perhaps.
To concentrate on the higher value stuff, like
Yeah.
buses and minibuses, where they're investing in R&D.
That seems to be the strategy. Trading volume for potentially better margins and focusing on those future-proof segments.
Okay, that makes sense. A strategic shift, which leads us perfectly into their operational performance.
Yeah.
But just before we dive into that, if you're finding this analysis helpful, please do hit that like button, subscribe if you haven't already, and maybe share this deep dive with others who follow the market. It really helps us out.
Yeah, definitely appreciate the support.
Okay, part 2, the engine room, operational performance. Let's start with the top line, sales revenue.
Right, so net sales, as you'd expect with lower volume, revenue was down, dropped 6% overall, landing at 16.174 billion TL.
And that was across both domestic and export markets.
Yep, both saw declines. Domestic down 5%, exports down 9%. Pretty much reflecting that overall 13% volume drop,
Yeah.
but maybe cushioned slightly by price increases or mix changes.
So fewer sales, less revenue. Logically, you'd think profits took a hit too, right?
That's what you'd immediately assume. But here's where the strategy starts to pay off. Gross profit. It actually held stable, right around 2.17 billion TL. Pretty much flat compared to last year.
Stable, even with lower revenue.
How? It points directly to that product mix shift we talked about. They sold fewer vehicles, but the ones they did sell were clearly more profitable. Higher margins must have offset the volume decline.
Fewer, better sales.
Okay.
Interesting. But the really impressive part seems to be further down in the operating profitability metrics like EBITDA or FOC, as it's called here.
Absolutely. This is where the operational efficiency story really shines. F of Oak didn't just hold steady, it surged, up a massive 56% year over year.
56%. Wow. To what level?
It hit 1.166 billion TL. That kind of jump, especially when revenue is down, shows really strong underlying performance, cost control, pricing power in their chosen segments. Something's working very well operationally.
And the margin must have improved significantly then.
Dramatically. The FAV-OK margin jumped almost 300 basis points, from 4.3% in the first 9 months of 2024 to 7.2% now. That's a huge improvement in profitability per lira of sales.
That's a powerful signal for management. And if we look even closer at the core operating profit, the ECS Faliet Kaya, which strips out some noise.
Yeah, that number tells an even clearer story about the core business making and selling vehicles.
Last year, 9M 2024, they actually had an operating loss there, right? About 80 million TL.
Correct. A loss of 80.5 million TL from core operations.
And now, 9M 2025.
A core operating profit of 314.1 million TL.
So they swung from an 80 million loss to a 314 million profit on lower sales volume. Well, that's phenomenal execution.
It really is. It shows the fundamental health of the vehicle business has improved dramatically. That R&D investment, the shift towards potentially higher tech, specialized vehicles, it seems to be translating directly into better unit economics.
The core business is definitely firing on all cylinders then. Okay, so operations look great. But then,
yeah.
Why did the final net profit, the bottom line, actually decrease?
Ah, yes. That's the confusing part, isn't it? Strong operations, but net income fell from about 469 million TL last year to 339 million this period.
How does that happen?
It comes back to that inflation accounting, TMS 29. The main culprit isn't the vehicle business itself. It's a line item called net monetary gain. Because inflation has been high, companies record a non-cash sort of paper gain based on their monetary liabilities versus assets. This year, ASUZU recorded a gain of nearly 1.5 billion TL from this.
1.5 billion, that sounds huge.
It is huge. But last year, that same gain was even bigger. It was 1.77 billion TL.
Oh, so the operational improvement, that 300 plus million swing to profit, was basically offset because this non-operational inflation-related gain was smaller this year than last year.
Exactly. The ghost of inflation accounting, as you put it earlier, masked the real strength in the core business on the final net income line. The trucks made more money, the accounting gain was just less.
Got it. That clarifies things significantly. Okay, operational strength established, net income explained. Now, let's talk about the balance sheet, specifically debt, because that number looked scary.
You're right to focus there. Net financial debt. It didn't just increase, it more than doubled.
Doubled from what to what?
It went from about 2.6 billion TL at the end of 2024 up to 6.167 billion TL by the end of September 2025.
Wow. Over 6 billion in net debt. That sounds incredibly risky. How can they possibly sustain that? Does it blow up their solvency ratios?
Well, here's another surprise. Because their operational profit, their EBITDA, grew so much, their main solvency ratio actually improved.
Improved with double the debt.
Yeah. The net financial debt to FAV-UK ratio, it fell quite sharply from 8.83 times down to 4.73 times.
Okay, explain that. So even though the total debt pile is much bigger.
Their ability to generate operating profit to cover that debt, that FAV, grew even faster. So relatively speaking, the debt load became more manageable from a servicing perspective. It's still high, don't get me wrong, but the improved earnings provide a bigger cushion.
Oh. Okay, so solvency, maybe not an immediate crisis, thanks to the strong EBITDA, but what about day-to-day cash? Liquidity. Can they pay their bills right now?
Now that is where the pressure is intense. Liquidity is definitely tight. Very tight.
How tight? What are the ratios showing?
All the key liquidity ratios are heading down. The current assets over current liabilities fell from 1.15 to 1.07.
1.07. So they basically have just 1 lira and 7 kurush in short-term assets for every 1 lira they owe in the short term. That's cutting it fine.
Extremely fine. Very little wiggle room. And the liquidity ratio, which is stricter because it excludes inventory, dropped even more, from 0.67 down to 0.54.
So less than 1 lira in easily accessible assets for every lira of short-term debt. That sounds like a strain.
It absolutely is. They're running lean, prioritizing investment and growth over holding lots of cash.
And this liquidity strain, it must show up in their cash flow statement.
Right, dramatically. The operating cash flow, it's deeply negative, and it got much worse.
So much worse.
Last year, the cash flow from operations was negative 633 million TL. This year, it's negative 3.5 billion TL, minus 3.519 billion.
A 5-fold increase in the cash burn from operations. What's driving that massive drain?
It's almost entirely down to working capital needs. That figure exploded, hitting 6.7 billion TL.
Okay, break that down. Working capital needs. That's money tied up in day-to-day operations.
Exactly. Primarily, it looks like huge increases in inventory, those higher margin vehicles they're building, and also in commercial receivables. They're making the vehicles, selling them, but they're waiting longer to get paid by customers.
So their very success shifting production, making better vehicles, is sucking up enormous amounts of cash right now.
That's the paradox. Growth and strategic shifts often require more working capital. They're funding this gap partly through that increased debt we talked about.
And presumably also funding their investments. That R&D doesn't come cheap.
Absolutely.
Real?
Total investment spending in the first 9 months was nearly 1 billion TL, 966 million.
And where did most of that go?
The vast majority, over 800 million TL, went into intangible assets. That strongly signals continued heavy investment in R&D, software, patents, future tech. It's necessary for their strategy, but yeah, it's very capital intensive.
Okay, so strong operations, but financed by debt and straining cash flow due to working capital and heavy investment. Let's pivot to risks. Currency risk must be huge for an exporter like this.
Definitely. They mention using forward contracts to hedge. You see about 58 million TL in derivative liabilities. But the underlying exposures are significant.
What exposures jump out?
Well, they have a big positive exposure to the euro, which makes sense given European exports. A 10% rise in the euro actually generates a gain of over 300 million TL for them, so that helps stabilize things.
Okay, that's a plus. What about the US dollar?
That's a negative exposure. A 10% rise in the USD would cost them about 65 million TL. Manageable, maybe, but still a drag if the dollar strengthens significantly against the lira.
But the one that really caught my eye in the footnotes was the Japanese yen. It looked like their single biggest liability exposure.
Yes, that JPY liability is massive in nominal terms. It's often overlooked, but it's a significant potential risk.
Why such a huge yen liability? Any idea?
It's almost certainly linked to their core partnerships. Isuzu Motors, Tuchu Corporation, their major Japanese shareholders and technology partners. This liability probably represents things like long-term debt, maybe technology licensing fees, component purchasing agreements, perhaps even capex financed in yen.
So it's tied directly to their history and their supply chain. A hidden risk embedded in their structure.
Exactly. It's a structural exposure.
Okay. Looking ahead, what's management saying? What's the outlook?
The general manager, Turul Arkan, his message in the report is pretty consistent. Continued strategic investment is the plan. Keep pushing on alternative fuels, the BIGE electric van, the Volt series, and keep trying to grow exports.
So no plans to slow down the investment or the strategic shift despite the cash strain.
Doesn't seem like it. They're committed to the path. They also highlighted publishing their first integrated report compliant with TSRS standards, which is, keeping up with modern corporate governance and sustainability expectations.
And for investors hoping for dividends.
The official policy targets distributing at least 50% of distributable profit, either cash or bonus shares. But there's always the big caveat, subject to investment needs and financial conditions.
And right now, those investment needs look pretty huge.
They absolutely do.
Yeah.
Which likely puts pressure on large cash dividends in the immediate term.
Okay, let's try to wrap this all up. Synthesize what we've learned.
Sure. I mean, the big picture for ASUZU is one of really impressive operational turnaround. That 56% jump in FAVX, swinging from an operating loss to a solid profit. That's management executing well on their strategy. The pivot to higher margin vehicles seems to be working operationally.
Yeah, the core business looks strong. But that operational success story is kind of overshadowed, isn't it? First, by that volatility in the non-cash monetary gains messing with the net profit figure.
Right. And second, and maybe more importantly, by the immense financial strain this strategy is creating in the short term.
That doubling of net debt, the terrible operating cash flow number, it all points to a company really stretching its finances to fund growth and this working capital bulge.
Precisely. They're facing a classic growth challenge, strong R&D, good operational execution, but very tight liquidity, and a huge immediate demand for cash. Management is clearly making a bet on the future.
So that leaves us and you, the listener, with a pretty critical question, doesn't it? Given this relentless push on R&D on these future electric vehicles and the massive increase in debt and working capital needed to fund it all, how long can these operational efficiency gains keep up? Can they generate enough profit fast enough to cover this huge, ongoing appetite for capital?
That's the tightrope they're walking. It's the key question for investors watching ASUZU right now. And if this deep dive helped you understand that balancing act a bit better, please do give us a like, subscribe for more analyses like this, and share it with your network.
Thanks for diving deep with us today.